Well, good morning, ladies and gentlemen. My name's Stephen Fletcher. I'm Head of Retail Distribution at GSFM. On behalf of all the team at GSFM and Epoch, thank you very much for joining the call today. I'm pleased to be joined by John Tobin. John is a Portfolio Manager of the Epoch Global Equity Shareholder Yield Strategy. So first of all, John, welcome.
Thank you, Steve. Good to be here.
Terrific. Thanks for joining the call today. Just looking at the agenda this morning, the presentation will run for approximately 25 to 30 minutes, and then that'll be followed by your questions. John will talk to us today about the shareholder yield portfolio in terms of performance, current positioning, and the outlook for dividends from global equities and the shareholder yield portfolio. I think, as you all know, the number one investment objective of this portfolio is to deliver income, roughly 4 to 4.5% per annum, and it has a long 12+ year successful track record in delivering that from a highly diversified portfolio of approximately 100 stocks. From a growth perspective, the market environment has been less favourable for yield-based strategies like shareholder yield, and these strategies, as we know, have lagged the broader market. However, as we witnessed in the latter part of 2020 and even more so in recent weeks, the vaccine rollout and economic recovery is driving a rotation in equity markets, with value and dividend investment strategies being the major beneficiaries. So today, as a way of updating you and your clients, I've asked John to walk us through the performance drivers of the Epoch Fund, talk to you about the portfolio and how that's positioned today to capture future growth, and also discuss the outlook for dividends. So please ask questions as we go along through the session. You can do that by entering your questions in the questions box at the bottom of your screen, and we'll certainly try and answer as many of these questions as we can at the end of the call. But John, with that, maybe I could hand over to you and we can kick off. Thank you.
Thanks, Steve, and good morning, everyone. Thank you for taking the time to join us today. I've got a slide deck prepared for you, and as Steve suggested, I'm going to talk about basically three things. I'll start off with a few slides to talk about the performance context for 2020, give you some ways to think about how to put the fund's relative performance in 2020 into an appropriate context. I have a couple of slides then to talk about what I would term dividend resilience, the resilience of dividend-paying stocks and companies in the face of the challenges posed in 2020, and then talk about the portfolio outlook and positioning. So to start off and talk a little bit about what was happening in 2020, as Steve alluded to a second ago, it's dividend-paying income strategies with a value tilt or bias were pretty disadvantaged in the market environment last year. And what we've done here with this slide, we're just looking at some indices. So we have the MSCI World Value Index, the MSCI World High Dividend Index, the MSCI World Momentum, and the MSCI World Growth Index. And they tracked along, this chart goes all the way back to 2005, and they tracked along fairly closely. You start to see in around 2017 a bit of a divergence, but a really dramatic divergence took place in 2020. And you can see the two lines that are clearly going up are momentum and growth, and the two lines going in the other direction are value and dividends. And so the shareholder yield strategy, being a dividend strategy with, if you will, a value tilt, was facing some pretty significant relative performance headwinds last year. One of the things that as we've talked about it and thought about it and tried to analyze our portfolio's performance in our own shop, we came upon this analysis. And what we're showing here, we called it the Fab Four, so apologize for that. But we've got four stocks here: Apple, Microsoft, Amazon, and Tesla. And at the top half of this chart, you can see, going back 5 years, how the weight of each of those stocks in the MSCI World Index was increasing over time, and then with almost a discontinuous jump in 2020. So from 2016 when the four stocks together represented a little over 4% of the index, to the end of 2020, when they represented, the four of them together, over 11% of the index. And what's really striking, if you look at the bottom part of the chart, now we're looking at the contribution to return for those four stocks. And it was certainly the case that in 2016, 2017, 2018, well, 2018 is an aberration because of the negative return there. But 2019, you could see that these stocks were contributing a significant amount of the return for the index. But in 2020, these four stocks accounted for almost half the return of the MSCI World Index, which is really remarkable because this is an index with about 1,600 stocks in it. Those are the four stocks that were driving the market last year. And let me point out, if it isn't obvious, these are the types of stocks that it's hard for us to invest in stocks like this. We do own Apple, we do own Microsoft. Those are companies that generate cash flow, that pay dividends, that do share buybacks. So they work for the shareholder yield strategy. Amazon doesn't pay a dividend. Tesla doesn't pay a dividend. So some of the stocks that were really powering the market forward last year are stocks simply outside of our investable universe, outside of our opportunity set. Another way of looking at this, another perspective, if you will, on this divergence between dividend and value-oriented strategies and growth and momentum-oriented strategies. If you look at the shaded box up above, so I've highlighted in blue the 1 year percent change. So this is for 2020. And again, you can see those four indices, growth, the overall world index, dividend, and value. So in 2020, the MSCI World Growth Index was up almost 34%. The MSCI World, and these are in dollar terms, US dollar terms. The MSCI World Index was up almost 16%. The High Dividend Index, flat, and the Value Index, down. I think what's interesting to point out here, and what I hope you'll see, if you look at the Q4 column, which is the one that's labeled QTD, quarter to date, so that's fourth quarter of 2020, you can see that as autumn arrived, we saw a change in investor sentiment and a growing enthusiasm and optimism around the end of the pandemic, the possibility that vaccines were coming, and a rotation started to take place. So you can see much more balanced performance among those four indices in the fourth quarter of 2020. And again, shareholder yield is not a traditional value strategy. Don't want to suggest that, but because of its focus on dividends, it does have something of a value tilt. One more chart to share with you. And I think, honestly, this might be the most important slide that I'll share with you this morning. Again, as we were thinking in our shop and talking about what it was that happened in 2020, how should we think about our performance, both on an absolute and a relative basis? And what occurred to us is, even though you look at 2020 as a whole, and if you see a report, it will show that there's a significant gap between the index return, the benchmark index return, and the portfolio return. But if you break down the period, the year, into two distinct periods, a picture emerges that I think is very informative. So on the left, that's from March 23rd through the end of August. March 23rd was the trough of the market. It really doesn't matter what index you pick, whether it's the MSCI World Index, the Standard & Poor's Index, pick your index. March 23rd was the trough. So from the trough to the end of August, for a 5-month period, the MSCI World Index in US dollar terms was up 54.5%, 54.5% in 5 months. That's extraordinary. The bar that shows the global equity shareholder yield strategy in US dollar terms was up 41%. So we did enjoy a very significant recovery from the first quarter drawdown. So from March 23rd, the trough, through the end of August, we were up 41%. but we were 13.5 percentage points behind the benchmark index, MSCI World Index. But from the end of August through the end of the year, for that 4-month period, you can see that there's a much tighter grouping, that the shareholder yield strategy was up 9.2% in US dollars. The MSCI World Index was up 10%. And the MSCI High Dividend Index was up 8.8%. So a much closer grouping. Now, the chart I'm showing you here runs through the end of December. This pattern has continued. And through the end of February, indeed, through the middle of March, through today, the shareholder yield strategy continues to track closely with the MSCI World Index and even a little bit ahead of the MSCI World High Dividend Index. So as we think about the relative performance and the absolute performance of the strategy in 2020, we tend to focus, our attention is drawn to this episode from the trough through the end of August, when the market really came back at a significant pace and we lagged behind. So the magnitude there is material. As I said, 13.5 percentage points. I point out, by the way, just for the sake of, I guess, completeness, the strategy historically has been one where we would say you should get good upside participation with this strategy. You should get good upside participation and good downside protection. Those should be characteristics that you expect to see with the global equity shareholder yield strategy. In this episode, when the market was up 54.5% and we were up 41%, that's 75% of the upside. So while the absolute magnitude is quite large, and the gap in absolute terms at 13.5 percentage points is large, it's consistent with the historical behavior of the strategy to provide 75 to 80% or so of the upside. So, it appears to us that while the relative performance of the strategy may not be very flattering, in many ways we can make an honest case that the strategy performed as expected in many ways in a very, very challenging period. So I'll turn now to what maybe you'll call, I can call the second topic I wanted to discuss with you, the resilience and durability of dividends. Back in, just about a year ago, but in the dark days, if you will, of the onset of the pandemic and the market drawdown in March in particular, early into April, there was a fair amount of discussion, a fair amount of reports in the press, the financial press, about the death of dividends. And we did a webinar, which maybe some of you saw back in April of 2020. We titled it, "The Death of Dividends Greatly Exaggerated." And our point of view was, we're reading about observers, saying that, gee, this has been such an unprecedented thing. The pandemic has hit, global pandemic, global recession, sudden and quick recession, that companies everywhere will be forced to cut dividends, to eliminate dividends, to stop share buybacks. And our perspective was, we think that those predictions are too dire. And we did, in our webinar, we made the case, we looked at a lot of historical data, and we said, if you look at historical data, what you see happening in recessions is earnings goes down, dividends go down in aggregate, but dividends go down less than earnings. So this is a chart that looks at the Standard & Poor's 500 companies, and you can see the past 4 recessions, including 2020. And what you see reliably repeating itself is this phenomenon where earnings go down more than dividends go down because companies try to maintain their dividends. The box at the bottom shows that the 2020 recession was fairly typical. What we're showing there is the average for 9 recessions going all the way back to 1955, and the average peak to trough decline in earnings was about 20%, while the average peak to trough decline in dividends was about half that, about 10%. So what we saw in 2020 was consistent with what we have seen in the past more broadly during recessions when it comes to earnings and dividends pressures. Significantly, and we made this point as well in April in our webinar, what we've seen historically is that earnings pressure and dividend pressures tend to be concentrated in certain industries. Other industries feel less pressure on earnings and less pressure on dividends. So as you look at this table, you can see, again, for the sake of an example, we're focusing on the Standard & Poor's 500 index, but the first column shows the change in earnings per share, peak to trough, during COVID by sector. And you can see that some sectors were significantly affected. Industrials, down 65%. Consumer discretionary, down 52%. Whereas sectors like consumer staples were up. And other sectors saw much smaller declines in earnings. The column on the far right shows the percent change in dividend per share for the companies in those sectors, in those S&P sectors. And again, you can see that there are some sectors where the dividend pressures were pronounced. Consumer discretionary, industrials, financials, but it's not uniform across sectors. And that was the point that we made when we delivered this webinar back in April. We updated it in a webinar in November. And I think even as we update it for today's presentation, we feel that this was the correct assessment, that the pressures on earnings and dividends would be felt more significantly in some sectors than in others. So despite these relative performance headwinds, and despite the pressures that we saw in 2020 on some companies, in some industries, on their ability to generate earnings and on their ability to pay dividends, what I would draw your attention to on this slide is the lower left-hand corner, if you will, history of portfolio companies that increase dividends. We have tracked over time, over the history of this strategy, which goes all the way back to 2006. We're showing here, going back to 2008, the number of companies in the portfolio each year that increased their dividends. And you can see that in 2020, we actually had 67 companies in the portfolio increase their dividends. The vast majority of companies maintained their dividends, but we actually had 67 companies during the course of 2020 who were able to raise their dividends. And you can see it's less, of course, than 2019 and 2018, but order of magnitude, it's consistent with what we've seen historically over time with the strategy. The chart on the top left, labeled Abundant Steady Income, shows the dividend yield of the portfolio over time. The dark line at the top is the dividend yield for the shareholder yield strategy. The blue line below is the yield on the Barclays Global Aggregate Bond Index. And the point that I would make that this particular slide shows is that the strategy has been able to maintain a dividend yield in the 4 to 4.5% range throughout its history. And we can continue to be able to deliver that level of dividend yield. The last thing I'd point to on this particular slide, I mentioned this a moment ago, this is a strategy that should give you good downside protection, and it continues to have that characteristic. So when the market is negative, and this is the actual history of the strategy over its 15-year history, if you look at episodes, when the market was negative, the portfolio has outperformed 72% of the time, and it outperforms by, on average, 3.3%. And when you look at episodes when the market was down significantly by more than 5%, in those episodes, the portfolio outperforms 83% of the time and by an average of 4.5%. Now, I'll say here, this isn't, as you look at 2020, one of the questions that we've been asked and one of the questions we ask ourselves, we had a big drawdown in Q1 2020 and the strategy underperformed in that quarter. So we did not deliver the downside protection that you would have hoped for in Q1 2020. If you look back briefly at history, you could say, gee, in fourth quarter of 2018, there was a big drawdown. And in that period, the strategy did deliver very significant downside protection. So what was different between those two periods? We've done a lot of after the fact analysis, but to sort of cut to the chase and to summarize it as briefly as possible, the difference between those two periods, I would argue, Q4 2018, as you may recall, was a period when the economy, people were worried about economic growth slowing down. People were worried about recession. The central banks around the world were trying to normalize policy. The Fed in the United States had raised rates in December of 2016, raised target rates 3 times in 2017, and then had raised the target Fed funds rate 4 times in 2018. So there was a concern that perhaps the central bank had overdone it and the economy was going to slow down. And of course, while that's happening, we've got a trade war blossoming between the US and China. So that was the setting in Q4 2018, and it gave rise to a rotation from growth stocks to traditional defensive sectors. And in that kind of rotation, in that period of time, the shareholder yield strategy delivered very good downside protection. What was different about Q1 2020 is a different macro environment altogether, if you will. Pandemic arrived, a very sudden and abrupt change in government policy around the world, stay-at-home orders, closures of non-essential businesses. For many businesses, business came to a sudden and complete stop. And what we saw in Q1 of 2020 was not a rotation from growth sectors in the stock market to defensive sectors in the stock market. What we saw broadly was a rotation out of everything into cash. So in that kind of an environment, it was very challenging for our strategy as well. And we did not provide the downside protection in Q1 of 2020 that we might have hoped for. So now, this is a chart that shows just the track record of the strategy. I'm not going to dwell on this. You've seen this before. It's the entire 15-year history of the strategy. What I want to get to, and then save some time for your questions, is a summary of our outlook and positioning. These are the top 10 stocks in the portfolio as of the end of 2020. As you may know, this is a strategy that is a very diversified portfolio by design. We have over 100 stocks in the portfolio. We limit our positions to no more than 2.5% per name. We usually don't go above 2. Once we go above 2, it's usually when we start to trim names back. So the top 10 here is 17% of the portfolio, and the portfolio weights you see for these top 10 stocks, all below 2%. So no individual stock concentrations. You can see there's a variety of exposures here, whether it's by sector or by country. And finally, the 3 columns on the right with the check marks, what we're trying to identify there is how these companies deliver shareholder yield, dividends, share buybacks, and debt reduction. Turning to the outlook. So I think the way I'd summarize it is the near-term macroeconomic outlook is challenging. I think we still have to admit we're not quite out of the woods yet. But nevertheless, the rollout of the vaccines around the world give us reason to expect that the worst will soon be behind us. There's an uneven pace of vaccine rollout. I'm surprised to say, I have to admit, that the United States is doing so well. We have basically not been doing a very good job handling the COVID pandemic, but at least at this point, we seem to be getting the vaccine part of the strategy delivered pretty effectively. I've had my first shot already, and I'm waiting for my second shot on March 30th. So what we see is an environment where we would expect that GDP growth is going to be weaker in Q1, but then it will increase for the remainder of the year, and we see momentum building. And we think that globally, the post-COVID expansion is going to be well supported by monetary and fiscal policy. Central banks around the world are saying that they are going to maintain an accommodative stance. Nobody's talking anywhere about raising interest rates anytime soon. Fiscal policy continues to be available. The United States, of course, just passed a very large fiscal package to provide support. So we see the economy starting to emerge as the vaccines roll out and monetary and fiscal policy continue to be supportive. What about interest rates? Well, people are focused a lot on interest rates and where interest rates may be headed. We think that interest rates are likely to see modest upward pressure, but with little risk of inflation until output gaps close. We think, therefore, there's little risk of interest rates breaking out and moving sharply higher. We've already seen the 10-year US Treasury move from about 0.5% back in August to about 1.6% today. So it's been a fairly significant move back in interest rates. But really, it brings us back to where we were in terms of the 10-year Treasury in January of 2020, before the pandemic hit. So we still think that even with a modest increase in interest rates, we're still in basically a lower for longer interest rate environment, and this is still going to be a challenge for income-seeking investors. One of the big questions, and this takes me almost back to where I started, will the markets remain in the thrall of these mega cap tech and e-commerce names? An open question. But we believe a strong case can be made that as the pandemic dissipates, as the vaccines get rolled out, as the global economic environment improves, this should support a broad-based market recovery, and that this should be an environment where we have a less narrow leadership of the market, and that should be an environment that's favorable for the shareholder yield strategy, both in an absolute return basis as well as in a relative return basis. We continue to believe, we've said this consistently throughout all of 2020, well-run companies will adhere to sound capital allocation practices. What does that mean? That means they will invest when they can earn a return above their cost of capital and otherwise return excess cash flow to shareholders through dividends, share buybacks, and debt reduction. We've seen that happening. We've seen companies in the fourth quarter already resuming with dividend increases and resuming share repurchase programs. We've just come through the Q1 earnings season, and we've seen many companies re-engaging with these programs, raising dividends, announcing dividend increases, announcing share buyback programs. So we feel vindicated that we said companies would stick to these sound capital allocation practices. They have. We continue to believe in that. We believe technology is a key driver for business models in this environment. It's a long-term structural phenomenon, and we believe that this generates more available cash for distributions to shareholders. And finally, we continue to believe that one of the foundational statements about the shareholder yield strategy is that in the long run, dividend yield and earnings growth, these are the primary drivers of stock returns. We think that's still the case. So Steve, I think I'll stop here and hopefully I'll be able to answer some of the questions that you're getting from some of the listeners.
Great. Well, John, thanks very much for the presentation. So let's move to a few questions that we're having coming through now. So the first question is just on the back of what you spoke about, with bond yields moving higher and potential for them to move higher from here, broadly speaking, how would rising bond yields impact the Epoch portfolio in the short term?
Sure. So it's a question that's on our mind as well. It's on everyone's mind. I think I begin by saying our view is that what we're seeing so far, as I just alluded to, this recovery in rates from very, very low levels is an indication of a global economy that's beginning to recover. This is what the Fed Chairman Jerome Powell has said, that he sees this as a healthy sign, it's a sign of an economy that's healing, of businesses and consumers that are beginning to return to normal. So shouldn't be a cause for alarm. And as I also just alluded to, I think there's limited scope for rates to rise much further in the near term. And it's based upon this view. Central banks have promised to maintain an accommodative stance until output gaps close, until the unemployment rates come down. In the United States, we still have about 10 million people who lost their jobs last year, who haven't gone back to work. So we've got some ground to cover before we close output gaps and put people back to work. So if that's the case, it's very hard to imagine that the Fed will start to raise rates anytime this year. With any luck, honestly, by the end of this year, we might hear that that is a topic of discussion for the central banks. But honestly, it's mid to late 2022, I think, before the Fed starts to actually move. I alluded a minute ago to the pattern that we saw in the last cycle. Fed moved very gradually with one 25 basis point increase at the very end of 2016, 3 moves in 2017, 4 moves in 2018. So I think this is probably how it plays out again here. We see the output gaps close. We see the central banks start to talk about raising interest rates. And then we see them move very, very gradually and carefully to move away from accommodation. One of the things that, in terms of the impact on the portfolio and the companies of the portfolio, I guess the way I would connect the dots is I would say if we are seeing these interest rates move up as a sign of a resumption of economic growth, of a return to economic health, well, what does that imply? That implies improving revenues, earnings, and cash flows for the companies that we invest in. So it should be helpful and beneficial for the companies that we invest in that kind of macroeconomic environment. And maybe the last point that I'd make, and I think this is maybe a little bit esoteric, but I think it's interesting. As I started at the beginning, and we talked about the market being focused on momentum and growth stocks to the disadvantage of value and dividend stocks. A strong case can be made that the companies and the stocks that are more at risk and more vulnerable in a rising interest rate environment are these so-called long duration companies, the companies where earnings and cash flows are years in the future. And as rates go up and you discount that, it has a much more pronounced effect on the present value, on price of the stock today. So those long duration growth companies are the ones that I think are more vulnerable in a rising rate environment, whereas companies that are generating earnings and cash flow today and paying dividends today, those are relatively short duration stocks. So for a variety of reasons, I think the kind of interest rate environment that we're looking at over the next year or two should, if anything, be helpful for the shareholder yield strategy.
Okay, great, thank you. So just talking about companies that are shorter in duration, as the economic recovery rolls through post-vaccine, do you think that companies with higher cash holdings will allocate that capital towards new investment opportunities, or will this provide a good opportunity for the fund to participate in increased levels of buybacks?
It's an excellent question. I think the short answer is we'd expect to see both, which is to say, and as I said earlier, we continue to, as a really fundamental foundational belief, companies should adhere to these capital allocation practices where cash flow is used to fund growth when the returns can be earned above the cost of capital, and otherwise the cash should be returned to the shareholders with dividends and share buybacks and debt reduction, shareholder yield. To the extent that a company has an opportunity to invest and earn a return above its cost of capital, we want companies to do that in the shareholder yield strategy. An important part of shareholder yield is finding companies with growing cash flows that support attractive growing dividends. So if you're going to have growing cash flows, you have to reinvest in your business. So we want companies to be good capital allocators. We want them to identify growth opportunities and allocate capital in that direction. So it may very well be that we will see individual companies who will say, we see opportunities to invest, and as a result, we are reducing our emphasis on share repurchases this year in order to fund some of those growth opportunities. That's absolutely fine with us. We are absolutely fine with that. We look at companies, what we like to hear from companies is a capital allocation practice or a policy founded on, we like to pay a dividend, We like to grow the dividend with earnings on a regular, consistent, transparent basis. And we use share buybacks in a variable way. If we have excess cash flow, we'll fund share buybacks. If we have investment opportunities, we'll dial back the share buybacks and dial up our capital spending or even our M&A activity. I think we'll see some of that activity, so we'll see both. But if the question is, do you think that we're going to see some kind of a widespread trend across companies, across sectors, across geographies, where companies are canceling share repurchase programs because they're funding all of these exciting growth opportunities? No, I don't think we're going to see that.
Okay. John, I've got a question around the fund, and it's an interesting one. Why doesn't the fund use a high yield index as opposed to the MSCI World? And I suppose another way of maybe answering that is, what is the relevance of the MSCI World to you when you're constructing the shareholder yield portfolio?
So I'd say that's an excellent question. It's one that we've been asking ourselves a lot lately. And honestly, Steve, you probably know this, but this is something that has been a topic of conversation from time to time over the years. And to answer your question, I think it is a strategy where we have a certain objective. We're investing in, we want to identify companies that have shareholder yield characteristics, that have growing cash flow and that allocate that cash flow in some significant way to paying dividends, buying back stock, or paying down debt. And so we've always said we're really not managing the portfolio to an index. We're managing the portfolio to these objectives, and the market's going to move around us. And I would say for most of the history of the strategy, that approach was fine, because to the extent that we differed from our benchmark index, we didn't differ that much from our benchmark index. 2020, on the other hand, was, as we said at the beginning, there's a big gap between us and the MSCI World Index. On the other hand, if you look at the global equity shareholder yield strategy in 2020 relative to the MSCI World High Dividend Index, we're really, really close. So it could be that that's a better benchmark. That's a more representative benchmark for this strategy, because it has companies that are like the companies that we invest in, and it doesn't have the companies that we say over and over are not in our investable universe. It doesn't have those tech and e-commerce stocks where they don't pay dividends, they maybe don't even generate cash flow. So it is a question, it's a relevant question, it's one that we've been asking ourselves, it's one that other clients have been asking us, and we haven't resolved that question just yet. But at the end of the day, I think even if we said, let's make a change, let's use the high dividend index as a benchmark because that's more representative, it's not going to change the way we manage the portfolio. It's not going to change the way we look for opportunities to invest. We're still going to be looking for the same kinds of companies. We're still going to be looking for the companies that have the same shareholder yield characteristics. The difference perhaps will be that when you compare us to a benchmark, if it's the high dividend benchmark, that we'll track much more closely with it. And we'll spend less time explaining to clients why, gee, there's a big gap between us and the core index. And of course, you have to recognize that there's a lot in the core index that we don't invest in because it's outside of our investable universe. So a good question, and one that we continue to wrestle with. Haven't reached a conclusion yet.
Okay, thank you. Another question here, the ever-increasing integration of technology in society increases the level of automation, potentially reducing the physical manual labour input. Do you think this will lead to a prolonged period of wage stagflation and difficulties in reaching inflation targets of central banks?
I think that's a good question. I can't tell you I've got the definitive answer for you. I don't know, but I think it's something that we have to be very mindful of. Both we as investors and portfolio managers, as we see the challenges that companies face that we potentially invest in, we as a society, as we try to come up with policies to address issues to improve quality of living, standard of living and the quality of life. It's been the case historically with technological advance that certain jobs are displaced, but certain new jobs are created, and overall employment grows. We saw this as we moved from agricultural societies to industrial societies. We've seen it as industrial automation has taken place. The question is, is it different now? Are we going to see such an advance of technology that it really and truly will be hard to find new jobs for people in new areas? So I think maybe the not too terribly satisfying answer to that question is we don't know, but we certainly have to keep an eye on that, because it is potentially, as the questioner frames it, it is something that potentially is disinflationary in a long-term structural way.
Okay, thanks, John. Look, we're coming up to 45 minutes, so we've got a few other questions which I think we may look to answer those over the next sort of 24 hours, and we'll get those answers out to those clients. But what I might do now, John, is just say on behalf of everyone at GSFM, thanks very much for taking the time. I know it's getting later in New York City, so thank you very much for the presentation. Ladies and gentlemen, thank you for joining. We really appreciate you taking the time. Thank you for your long-term support of the Epoch Global Equity Shareholder Yield Fund. I think there's no doubt it's been a frustrating and challenging period for managers with a value tilt, including Epoch's Global Equity Shareholder Yield Fund, certainly from a relative perspective. However, hopefully after hearing from John today, you have some extra information that you can share with your clients that I think explains why this has been the case. Now with the vaccine rollout, as economies around the world start to bounce back, the rotation of value stocks is certainly underway, and this has and will continue to support strategies like Epoch as that rotation is sustained. And the last point I will make is that ultimately the Epoch Fund is a dividend investment strategy that has delivered greater than 4.5% income per annum every year since the inception, going all the way back to 2008. So with income very difficult to generate from defensive assets today, a high quality global equity portfolio with sustainable and growing income, we believe plays an effective and very important role right now within a retiree's portfolio. So that concludes the session. We'll get the presentation along with CPD points out to you very, very soon. For all the Irish on the call today, happy St. Paddy's Day in Australia. Hope you have an enjoyable day. Everyone else who's looking for an excuse to have an alcoholic beverage later today or tonight, enjoy. And ladies and gentlemen, we look forward to seeing you all again very, very soon. So thank you.
Thanks, Steve. Cheers.
Thanks again, John.